I'm solving sums IND AS 13. Provision for contingent assets, provision for contingent liability, and contingent asset. IND AS 37. Question number 3. X, a chemical limited, is a opening in the vicinity of a river since 20 years. A community living in near X Chemicals Limited claimed that its operations has caused to contamination of drinking water. X Chemical Limited has received a notice from the government environmental agency that official investigations will be made into the claim of pollution caused by the entity. It is found that X Chemical Limited has caused contamination, then penalties and fine would be levied on it. X Chemical Limited believes that it has implemented all environmental safety measures to an extent. It is unlikely to the cause of pollution. Management is not sure whether it has all the information about the entire 20 years. Therefore, neither management nor external experts are able to assess X Chemical Limited responsibility until the investigation has completed. In such a situation, how should management X Chemical Limited account for the liability? Now, this case, what we will do? 1 minute. We hope this MBS 30 some presence should be complete. Charging. 1 minute. Charging and now in this case, I understood the scenario, understood. I'm going to read out answers and also. Just 1 minute. So, as per the standard in the present case, the available evidence does not support conclusion that a present obligation exists. However, there is a possible obligation which exists and will be confirmed upon the completion of the investigation. Therefore, management should disclose in the contingent liability for potential penalties and fines that may be imposed if contamination is proved. So that is that. Next, X Limited. X Limited has entered into an agreement with its selling agent Y, in accordance with the which X Limited has to pay a base percentage of commission on export sales and an additional commission to be paid if the export incentives are received as per the accounting policy. X Limited. X Limited, it recognizes export incentives with actual when actually realized on account of the uncertainty in realizing which incentives have not been received for the year 2001-2. However, X Limited hopeful for receiving the export incentives in the year 2002 and 3. In the financial statement for 2001-2002, should X Limited provide the both base commission and additional commission? This is the question. See, see, in this case, X Limited has entered into an agreement with selling agent Y, in accordance with which X Limited has to pay base percentage commission on export sales, and an additional commission is to be paid if the export incentives are received as per accounting policy of X Limited. If per policy of X Limited, it recognizes export incentives when actually realized on account of the uncertainty in realizing such incentives. Export incentives have not been received for the year 2001 and 2. However, X Limited hopeful of receiving the export incentives in the year 2002 and 3 in the financial statement for 2001 and 2002. Should X Limited provide both base commission and additional commission? This is the question. For this question, with reference to IND AS 37, I am going to answer that question. What is the answer? Okay, what is the answer? Answer is, so far as the base percentage is a sales commission is concerned, it is a present obligation arising out of the past event. The obligation event takes place when the sales are made, and also, since commission is based on percentage of sale, reliable estimation can also be made. Therefore, the base percentage of sales commission should be provided. The base percentage of sales commission should be provided. However, in respect of additional commission, it is to be paid when the export incentives are recognized, and export incentives are recognized only when it is received. Therefore, the application event will arise only when export incentives are received. Hence, no provision for obligating the event will arise only when the exports incentives are received. Hence, no provision for additional commission is to be made in the financial year 2001 and 2. The expectation of X Limited to receive the export incentives in the next year would not make any difference as on 31st March 2002. This is the answer. When we will create provision, it should be in the present obligation because of the past event. Then only we will create a provision. If past obligation, past event, present there is no obligation, but future is going to meet, then based on the percentage. If it is 100% is sure, we'll create a provision. If 100% is not sure, 50% is less, then contingent liability will create a liability and disclosure will be there. As far as that is only meaning. But in this case, what happened? No, so far as the base percentage of sales commission is concerned, it is a present obligation arising out of past events. The obligating event takes place when sales are made, and also since commission is based on percentage of sale, reliable estimation can also be made. Therefore, the percentage of sales commission should be provided. However, in respect of additional commission is to be paid when export incentives are recognized, and export incentives are recognized only when it is received. Therefore, the obligating event will arise only when export incentives are received. Hence, no provision for additional commission is to be made in the financial year 2020, 2001 and 2. The expectations of X Limited, the expectations of X Limited to receive the export incentives in next year would not make any difference as on 31st March 2002. That is the answer. Next, question number 5. An entity sell goods with warranty under which customers are covered for the cost repair of any manufacturing defects that become apparent with the first 6 months. After purchase, the minor defect were detected in all products sold. Repair cost of 1 million would result if the major defects were detected in all products sold. Repair cost of 4 million would result. The entity past experience and future expectations indicate that for the coming year 75% of the goods sold will have a no defect, 20% of the goods sold will have a minor defect, 5% of the goods sold will have a major defect. Assess the probability of an outflow of the warranty obligation whole. Here they given how, what is the event, what is the percentage is going to meet as a liability. In such case, the expected value of the cost of the repair at the 75% nil, at the 20% 1 million, at the rate 5% 4 million. All together will be 4 lakhs. For the 4 lakhs only, you need to create a provision. That's it. Next question. X Solar Power Limited, a power company, has a present obligation to dismantle its plant after 35 years of useful life. X Solar Power Limited cannot cancel this obligation and transfer to third party X Solar Power Limited has estimated the total cost of dismantling 50 lakh. The present value, which is 30 lakh, based on the facts and circumstances, X Solar Power Limited considers this risk factor 5%. The risk that the actual outflow would be more from the expected present value. How should X Solar Power Limited account for the obligation? The obligation should be measured at present value of outflow 30 lakhs. Further risk adjustment is 5%. Then the total value 30 lakhs into 105%, that is called 31 lakh 50,000. So the liability should be recognized 30 lakh plus 5% is the risk factor. Then 31 lakh 50,000 we should made a provision. Now next question number 7. X Limited X Limited has an obligation to restore the seabed for the damages has caused in the past. It has to pay 10 lakh cash on 31st March 2003 relating to this liability. ABC Limited management considers that 5% is an appropriate discounting rate. The time value of money is considered to be material. Calculate the amount to be provided as of 31st March 2001 for the cost of restoring the seabed. Discounting factor 5% and year on 31st March 2001 or 1st John 2005, 0.907. The present value provision 31st March 2001 is 10 lakh into 0.907. It's called 9 lakh 7,000. See, the amount of increase in the provision resulting from unwinding of discounting to the reflect the passage of time should be included as an element of borrowing cost determining the profit of the loss of the for the year. The provision should be the provision should be initially recognized. The provision should be initially recognized at 9 lakh 7,000, which is the present value of 10 lakh discount, 10 lakh discounted at 5% for 2 years. At the end of year 1, 31st March 2002, the provision increased to 9 lakh 52,350, and the difference of 45,350 is recognized borrowing cost. Similarly, for the year ending 31st March 2003, the provision will increase 10 lakh and increase being recognized as a borrowing cost. Consequently, at the end of the year 2, the amount of provision will be equal to the amount due 10 lakh. Note, there may be some difference in amount due to approximation limiting discounting factor to 3 places decimal, which can be overcome either by full scale calculation or adjustment at the end. In this case, what happened when they given discounting factor, we should use discounting factor for creating a provision of liability, for creating a provision for future expense or past even present obligation. Here what happened, ABC Limited is an obligation to restore the seabed for the damages it has caused in the past. It has to pay 10 lakh cash as on 31st March 2003 relating to his liability. ABC Limited management consider that 5% appropriate discount rate, uh, the time value of money is considered to be material. Calculate the amount to be provided at 31st March 2001 for the cost of restoring The seabed. Discounting factor 5% second year 31st March 2001 is 0.907. The present value of the provision as 31st March 2001 is 10 lakh into 0.907, that's called 9 lakh 7,000. The amount of income, the amount of increase, the amount of increase in the provision resulting from unwinding of discount to reflect the passage of time should be included as an element of borrowing cost in determining the profit or loss of the year. The provision should be initially recognized at 9 lakh 7,000, which is the present value of 10 lakh, discounted at 5% for 2 years. At the end of year 1, 31st March 2002, the provision increases to 9,52,350, and the difference of 45,350 is recognized as a borrowing cost. Similarly, for the year ending 31st March 2003, the provision will increase to 10 lakh. And the increase being recognized as a borrowing cost, consequently at the end of the year 2, amount of provision will be equal to the amount of 10 lakh. Note, there may be some difference in amount due to approximation limiting discounting factor to third place of decimal, which can be overcome either by scale of calculation adjustment at the end. This is so question 3 questions we read. Next question number 8. Question number 7 should do work on that. Then only we can come. So I'll do next video next. Thank you.